Hi, I just wanted to give a kind of my take on options volume. There's a lot of people talk about options volume, in my opinion, incorrectly, and I just wanted to kind of walk through in this video what implications that might have on trading, or more importantly, what implications that doesn't have on trading. So. What I've got here is this is from Quick Strike, and it just shows the open interest of the December contract. And you can see. I think this is net open interest. Obviously, around the big round numbers, there's big spikes of open interest, and believe it or not, on the higher side, they're all calls. And on the lower side, the high peaks are puts, unless the market's kind of travelled up over the life of that option, which it has done. We've come up really from the 50s through the life of the Z contract, so you'll find there's some balance around the 65s, and you'll even see that there's some balance in the 60s because we've come up there as well. So people will be owning that, but there's two things. One is the vast majority of options that are traded and the size that goes through, they are done either laid up, as the term is which it means that at the time, if somebody asks for, let's say, a 70-75 put spread that might be 20 delta, they'll lay it up, which means they put a reference. So they'll turn around and say, well, I want to, if the front month price is 68.05, they'll lay it up at 68.05, and everyone will work to a defined delta of, say, 21 deltas when pricing that option for people, which means that there's no exposed delta left over. So that means that when the transaction is happened, if somebody buys that put spread for, let's say, keep the numbers around 100 lots, at the same time they trade 21 lots of the futures contract, which means they have a net delta of 0, and all they are basically doing is taking a volatility position. The seller of the put spread has sold volatility. It might not be the best example for defining the selling of volatility, but that's what's happening. It's the same with butterflies. It's the same with all other strategies. Many of them are laid up, and also many of the strategies that people are trading, most likely you'll see in these big round number activity, because people will be trading flies. So they'll be trading a 60, 65, 70 fly, or a 70, 75, 80 fly, as you can see here. So quite likely this looks call fly heavy. Now, a 70, 75, 80 call fly would probably have a delta of, off the top of my head, 6 in December, maybe slightly higher in as we move in through the months. But what I'm trying to show is that the volume that's traded does not suddenly mean we're going to 50 because somebody's gone out and bought loads and loads of 60 puts. If we look at if we go back to this report here, you can see, in the Z, just to kind of keep it to the front month, because that seems to be where everyone gets their panics. The highest activity, and this is what kind of 5 or 6 people asked me there. Oh my gosh, people are buying the 58 puts. Well, first of all, we don't know if they're buying. It's just showing that there's activity there. And before kind of everyone gets ahead of themselves, the 58 strike put, I believe, is a... I'm trying to wonder how I'll find that. I'm pretty sure it's the 3 delta option. So if we go back, volume, detail, most actives. So 6,000 has gone through in most like, almost taking me back to the same page. Openings. Right. Okay. Right. So 58 strikes should bring up. So I think it's 3 delta off the top of my head. Right. There you go. Look. So the 58 is a 3 delta option. And what people are saying, oh, there's loads of people buying 58 strikes. There was, I think, a change in volume of 6,000. So, that it's for every 1,000 lots traded, it's 30 contracts of outright needed. That goes through in a second. And to do 6,000 of them, it's a few hundred. And in most likely cases, what's happened is the sellers of the 58s are just sitting there collecting them back, because nobody will want wild strikes. As we get into what I mean by that is, no one wants that amount of exposure coming into expiry, whilst we might be looking that we've still got 15-20 days left in December. Most people don't want that kind of gamma that's in a closing month. So we could quite easily spill down to 64, 65. It's highly unlikely that the 58s will go off in the money, but it gives the gamma curve of the guy that's been sitting short those a problem that he doesn't need to manage, when he can collect them very quietly on the bid of a 3 delta option. It's the value of options volume is that there's an awful lot of hedging of the outrights required. The actual volume and strikes chosen by the participants is, in my personal opinion, largely irrelevant. Because most people will be acting in a delta neutral manner. They're not looking for directional plays, they're looking for volatility plays. That means that they are looking to always maintain a delta neutral model, and whether or not they decide to go for flies, put spreads, whatever strategy they can kind of think of, whether it's iron condors, whatever, they'll be looking to capture the change in volatility. The directional play of these strategies is quite low as far as how much exposed delta they'll be having. So what should be focused more is looking at when might there be points of hedging, which is nearly impossible to look at. But there's so much focus that goes on and looking at volume. And for me, it's a bit like alchemy. It's hocus pocus stuff. We can see here, there's been loads of calls adjusted. You've had a big dip all the way down from 76. The guys who sold all of the calls up there, clearly, because if you look at the risk reversal of a previous video I did, if we look very quickly here, I'll show you. This should bring up the risk reversal. You can see rally up here in crude. Risk reversal didn't really go above 0. Loads of people willing to sell calls up there. And lo and behold, back down we come. And, there's an adjustment of people scooping back or dumping out of their calls that they sold up there at 76. There's not all of a sudden everybody's selling upside, so we're going down. It's adjustment and what needs to be kind of looked at. It's largely impossible for day traders to even potentially contemplate getting involved with trying to look at what a longer term option play is doing. If anything, it's just going to cause more controversy, more losses, and that's where that understanding your time frame is really important. And kind of what sparked this for me to do this video was people saying, oh, we're going to 50 because somebody's bought a load of 55 puts in December. Apart from sighing, that's not the case at all. It's, yes, somebody would have bought 55 puts, but he may have been short them, thousands of them. And they, we even from moving down from 76 down to 68, that if you actually look at the lifetime against theta, the time decay that's occurring, those would have been decaying in so quick, because we don't have many days left, that he'll still be collecting profits on them if he's short. I think without truly understanding the net exposure, which no one can see, it's alchemy trying to chase large options trades or even small options trades with small deltas. They're not worth doing. What if anyone wants to kind of delve into something that could be worthwhile is looking at where option market makers would be looking at hedging to maintain delta neutrality as a position changes, because whilst I described earlier in the video that you would be laying up a trade upon execution, you may, as the market moves, that would require hedging changes, and understanding where those hedging changes might be is certainly an interesting scope. So this is quite a nice view of open interest, just going out 6 months, and you can just it's the at the money's here, strikes are in grey. I don't know why the yellow's highlighted, but the greys, and you can see the small contango as we now go up a strike going out. But the heat's around the big round numbers, and that's not because that's not anything else, but it's really easy and really lazy for guys trading volatility spreads to pick big round numbers. So right now, if you're looking for a marginally directional trade, but that you want to maintain short volatility, to stop any rise up, you go 670, 75, 80. And if you want a downside play, potentially you could even leg across the months, but you'd go 55, 60, 65. That's how people are structuring what they're doing, which is for building up their portfolio of their position. It's not the inter-block activity like this heat you're seeing around here. These 67s, these could be, people that are kind of trying to be a little bit cute, because we know crude sits inside these 67s, 62s for long periods of time, which you can see is happening here. But there'll always be, and that's roll activity. Could be a few small directional guys using some deltas to play with. But the big stuff, this big increase that you see here in these 60s and these 65s is most probably people rolling out of the things that they've had higher and pulling back down here. And there's a little bit of heat around these 67s. I think as we're coming into the Christmas period, people might feel that crude settles down and they want to collect around here. But it's my point of doing this is it is virtually impossible to try and track the future direction of crude travel by looking at option volume, and that volume, don't even think about doing it on the weeklies. There's nothing really going on there, and it's representative mostly of a commodity structure. So we've got we always see a higher put skew for crude. It's sorry, not a commodity skew. It acts more like a equity skew, where we do have a slightly puts over. And that said, people will always favour getting more volatility for those strategies on those downsides. So all of a sudden, when we move down, people think, "Oh, we're going down further," because all of a sudden, all of those put strikes that are further down or bid up, because as crude falls. So if I go back, does that show that at all? Not really. This might. Actually, it's gone slightly too far. We've missed the days of the sell-off. There you go. There's a good Tuesday was a big sell-off day, so you can see kind of the run down the green line there, and volatility slowly ticked up. Overnight it closed 25% and made it all up to 27%. So it tends to be fine. Hard moves down in crude. You do see volatility gets lifted. And when that put wing is lifted, all of a sudden it becomes quite favourable to sell strategies that are capturing that higher volatility of that higher put wing. And you start to see heat maps like this, and then people think we're going to 50, and it's tea leaf reading. So hopefully this video will probably raise more questions than it's answered, but I'm happy to answer them.